We're looking at bonus season. I know this is everyone's favorite subject, but hate to break it to you, it's looking grim out there for bankers. Joining us now is Bloomberg's Sally Bakewell with more. So, Sally, how grim are we talking here?
Well, last year it was pretty disappointing. This year it's going to be pretty disappointing. And I think next year bankers are going to face more disappointment. So because of, this plethora of reasons, a prolonged deal slump, rising interest rates, stock market volatility, general inflation and cost pressures, we're going to see bankers facing, lower or flat bonuses this year. And particularly hard hit will be those that advise on mergers and acquisitions because the deal market has really been in this prolonged slump. We'll also see that bankers handling commercial and retail business in some of the regional banks could expect their bonuses to fall some 20%. For mergers bankers, it could fall as much as 25%. But there are some bright spots. Equity underwriting, they could see a bit of a bump of as much as 15%, thanks to the IPO market bouncing back a little bit in the later part of this year. And wealth management also, they could see a bit of a bump. So it's not all bad news, but I think the news ultimately is prepare to have a flat or lower bonus this year.
Sally, what about some of the Goldmans of the world, for example, or UBS, who have kind of an image issue and are trying to hire up more people and have more incentives? Is any of that showing through, or is it just those really specific cases?
I think some of those banks, like Goldman Sachs, they have made cuts to some of their staff. They have had to, they're grappling with inflation, and they have had to, and this prolonged deal slump, and so they've had to make some fairly significant cuts among some of their staffers, as have banks like Morgan Stanley and Citigroup. No one's really been particularly immune to this slump and to these conditions, but obviously, it's these banks, they do know they have to pay up for talent and they want to retain their best talent. So for those staff, they will probably go out, and bat for them. And we also see banks like Moelis, which are actually going on sort of a bit of a hiring spree, taking advantage of these conditions and that other banks are retrenching to sort of stock up on talent for when markets start to bounce back. So it's a very difficult thing for banks to navigate because they have to keep a lid on costs, but they probably have to, and one of the levers they pull for doing that is to cut staff, but at the same time, they do want to keep talent for when the market starts to rebound.
Well, and Sally, I remember the days not too long ago when it seemed like each and every day, because of this competition for talent, we were seeing a new headline about how much junior bankers were going to get paid at whatever shop they decided to go to. But it raises the question of what's going on with base compensation. If bonuses are going down, are they getting more money coming in consistently all the way up the pay scale, not just for the junior people?
Well, that's the interesting thing. For bankers, the size of their bonus usually dwarfs their base salary. Managing director can get paid from sort of $350,000 to $650,000, but the actual bonus can, boost that pay many, many times. So what they're actually paying at a base level, they're in this sort of complex situation of having to retain talent and paying up, but at the same time keeping that lid on costs. So it's hard to say really, what that looks like for a banker's bottom line salary.